Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel, where we are bringing the VRIC to you each and every week with our series of expert online panels. Today, we have Rick Rule from Rule Investment Media and Lobo Tiggre of the Independent Speculator back for round three. The people have greatly enjoyed our first two discussions, so I'm happy to welcome them once again to discuss gold, silver, uranium, the commodities complex in general. Gentlemen, it's great to have you both on the show once again.
Glad to be back.
Ditto. My pleasure. Thank you.
Well, I want to start the conversation with gold. Once again, having broken to new all-time highs, as Rick likes to always point out in nominal terms. We're sitting close to 2,600 at the time of this recording. I'm wondering, are we getting close to real all-time highs at this point? And another point I would like to touch on is why the mainstream financial media isn't discussing this in any great detail. We've seen a few articles here and there. We've even seen a few articles disparaging of gold over the course of it reaching where it is right now. When we go down the conspiratorial rabbit hole, a lot of gold bugs think that the mainstream media is working in concert with the government to suppress information about gold, because if people realized it was truly money, then the fiat currency system would no longer be able to survive. I'm wondering what both of your thoughts are. Lobo, I'll start with you.
All right, well, let me start with the conspiracy theory first. It may be true. We'll never know. Maybe if somebody writes a McNamara type kiss and tell all book a few decades from now, we'll find out in hindsight that is not investable, right? So true or not makes no difference to how I invest today. If it is true, the manipulators are spectacularly unsuccessful, but we'd still be looking at $250 gold, not $2,600 gold. That said, to the real gold price question, I've actually been looking at this recently, done some math on it. If you look at it, real in air quotes, what is real? If you use CPI, that's the enemy's number, if you will. So that's the most conservative case you can make, actually. If you adjust for CPI, instead of hitting all-time highs, if you look at the 1980 peak, the 2011 peak, we're actually hitting a series of lower highs. We're nowhere near, actually, we are near the 2011 peak. We're nowhere near the 1980 peak. That would take over pushing $3,500 gold dollar exchange rate. I don't like to call it a price because gold is money. It's a Forex issue. So it would take almost $3,500 per ounce of gold to top that 1980 high, at least the intraday high. So in many ways, all the promotion and excitement is very misleading, but it's clearly understandable. As a speculator who, to quote my master and mentor, Rick Rule, forget about what's inevitable. Like, it might be inevitable that fiats go to zero as per the conspiracy theory blowing up. That doesn't make it imminent. And I don't even trust myself to be able to figure out what's imminent. So I look at what's happening now. And what's happening now is a hockey stick in gold. What's happening now is a breakout. And by the way, one reason, and where we go with this, gold is one thing, the gold stocks are another. Sorry to hog the microphone here, but this is important. The gold stocks have underperformed. I've heard Rick talk about this. We've talked about it together. And I think one of the reasons why, besides the gross mismanagement of the opportunity in the last bull market, which is Rick's specialty, my view is it's also once bitten, twice shy. Everybody remembers 2011 and then this horrific 5-year bear market. And so the 2020 spike, a lot of investors were worried that was a peak and it was just going to be another 5-year bear after that. And they held on to that view and they held on to that view and they didn't want to buy the stocks and they didn't want to buy the stocks. Well, guess what? If, you should have realized after 3 or 4 years that it wasn't going down, that was a message. But now it's gone up instead of down. Like the next big move was not down. That is simply wrong. That view has now been put to rest. The next big move was up. Where it goes next, maybe Rick knows. I don't know. But this is important because it changes, I think, the dynamic for the stocks. And that's important because while the metal may be at nominal all-time highs, the stocks are not, and that's an opportunity.
Quick break here, guys. Today's episode is brought to you by Copernico Metals. Now, regular viewers of my channel will be familiar with the entrepreneur behind Copernico. His name is Ivan Bebek. Now, although a young man in this business, Ivan's already created tremendous value for his shareholders in the past, namely with Caden Resources, which he sold to Agnico Eagle, and Keegan Resources, which became a mine now owned by Galliano Gold. Now, Ivan has surrounded himself with expertise from BHP, Newmont, and Barrick on his board at Copernico Metals. Check out copernicometals.com. Now back to the interview.
And Rick, your thoughts, and also as Lobo mentioned during the last bull market, companies mismanage the opportunity. Do you think that they've learned their lesson at this point in time?
Of course not. Of course not. You know, we make fun of the government for inflation. The private sector can always do everything better than the public sector, including inflation. These guys, taken as a whole, the small public companies, can issue phony share certificates faster than the government can print money. And anybody who participates in the TSXV or the ASX needs to understand that, taken as a collective, this is a satrapy of private governments that exist to inflate, to maintain their own standards of living. If the government is the enemy, the market is the enemy too. You need to understand that. And just in the way that occasionally people amuse themselves by voting, people who voluntarily participate in equities markets like myself need to participate in securities analysis, and they need to vote with their own money. I mean, you need to understand that. It's important. Our mutual mentor, Doug Casey, used to describe the value proposition around these gold stocks as looking for something that would have been $1 billion opportunity had the prospector's mule not died. I think that's a wonderful, wonderful, wonderful description of the market. So protect yourself against government and protect yourself against management too. Let's get back to the original question, which Lobo did a masterful job by way of answering. In terms of manipulation, my question in the period 1982 to 2022 was, why would you bother manipulating something that was going down of its own volition? It doesn't seem to make any sense given the extraordinary strength in the dominant fiat currency, the US dollar, in a period of declining interest rates and American hegemony, given the strength of the long-term bond, that they would bother manipulating gold or silver because they were falling really due to gravity. They were falling because there was no fear in financial markets around the maintenance of purchasing power in US dollar denominated deposit products. Why would you manipulate something that was falling? If you have an answer to that, I don't, then you need to decide that there is some master class of manipulators who exhibit superior skills and superior intelligence. I'm not aware of the existence of said master class. Again, our mutual mentor, I say ours, Lobo's and mine, Doug Casey, once described central bankers as people who, if they didn't have such phenomenal family contacts and education, would be wearing masks when they entered 7-Elevens. I think that's a very good description of them as a class. So I'm not particularly afraid of manipulation. I do believe that gold will continue to do well in nominal terms. And I believe that gold will begin to do well in real terms. Almost nobody measures it in real terms, I guess because they think that they pay their bills in nominal terms. This is a mistake. Lobo publishes something called the International Speculator. And in about 20% of my portfolio, I'm a speculator too, but I'm an old, fat, bald, rich guy. So most of my portfolio is involved in investing, and some of my portfolio is involved simply in saving, in maintaining my wealth, ironically, so that I can give it to philanthropy when I die. And for me, that's where my gold is. My gold is insurance against the depredation of government on the Commonwealth, and against the deterioration of purchasing power, which I experience in US dollar denominated assets. this is a very boring answer for many of the speculators who are listening to this discussion. What they want to believe is they're going to wake up tomorrow and gold is going to be at 9,000 nominal dollars. And the gold stocks, of course, fronted by all these counterfeiters, aka management, are going to be up tenfold. I can entertain those people for a while, but it gets kind of boring being part of an ongoing lie. I think that you own bullion, if you own bullion intelligently, to protect your purchasing power. Occasionally, there's speculative excesses. Nobody, including the three people in this call, are smart enough to know when that will occur. And my disparaging remarks about gold equities have to be taken in the context that about 5% of the issuers generate such spectacular performance that they add legitimacy and luster to a sector that as a whole counterfeits more effectively than governments. That's quite an achievement. When I disparage speculative attitudes in favor of insurance and investing, my wife, Bonnie, a good friend of Lobo's, always laughs and she says, that's funny. All of the money that Rick invests carefully, he made speculating wildly. So anyway, both Lobo and I are prone to rants. You'll have to do your best to rein us in through the balance of this call.
No, I will do the opposite of that. I will allow you to remain untethered and free. I do want to talk about the gold stocks and get more into the speculation side of things because I recently had Adam Rosenswag and Lee Gehring on the show, and they said that gold miners have never been cheaper historically. They were talking about the large producers. So I imagine as we go further down the chain to explorers and to the junior cos, the exploration sector, we're going to see even lower valuations on a historical basis as well. Are you both seeing the same things? And obviously, you've already laid out, both of you, a lot of the pitfalls when it comes to these, especially junior mining companies, but the mining sector as a whole. I'm wondering if you could maybe expand on that because people always talk about 10 bagger, 100 bagger opportunities in the junior mining space. And there's always frustrated speculators online who are bemoaning the fact that they threw all this money into stocks that they did no due diligence on and they're not performing as they expected. So I'm wondering what both of your processes are for examining stocks, whether it's in the junior sector or whether it's the big producers, and any perils that you look for along the way. And Lobo, I'll start with you.
In a way, you've answered your own question there. If people don't do their own due diligence, let's move on to the next question. That said, to go back to your first point, though, I'll push back. Actually, no, I don't think there's more undervaluation or lower value on the junior end of the spectrum. If you have nothing, any valuation is excessive. I can see Rick nodding. I knew he would. I'm taking a riff off his tune here. But, what is the correct PE to a cash burning business, right? Logically, if you're going to use the same yardsticks or financial criteria that you apply to metrics for going concerns, none of them are investable, none. So no, the valuation question is just not there. And by the way, this is one reason why, even though I am a speculator, it's the independent speculator, not the independent sure thing or guaranteed 100 bagger, right? I'm very, very reluctant to go into pre-discovery exploration because there's nothing to value. I mean, maybe the gleam in the geologist's eye or the management's reputation, their pedigree. There is something to be said for backing the jockey, not the horse. And Rick is very good at this, but I'm just really stubborn. I want to see rocks that I can believe in. And so, and there's money to be made after the initial discovery with much less risk in my view. But there, if you are going to go there, do your due diligence, find the kind of people that Rick attracts to his conferences. That's why he does that. And that's a way to get in on that early hockey stick. But on a value basis, understand that what you're making is not an informed decision on a value proposition. You are maybe even speculating as being a little generous to call that sort of gambling.
That was a fantastic breakdown. Rick, your thoughts?
Well, first of all, that episode that you did with those gentlemen was spectacular. So congratulations. Anybody who hasn't listened to that should do their balance sheet a favor and listen. I disagree with some of the conclusions, but that doesn't matter. That's what a market is. It's a forum for expressing disagreement. I think that if you examine the seniors as a class, that they're probably fairly valued. I think in the absence of higher gold prices, that at least 50% of the XAU is overpriced. People need to understand that. Ironically, if the gold market really performs, it's going to be the ones that are overpriced that perform the best. If you think about this, if you're selling your gold for, let's make the math simple, $2,500 an ounce, and your AISC is low, let's say $1,000 an ounce, you have a $1,500 margin. If you're much less efficient and you're producing gold for $2,000 an ounce, you have a $500 margin. The net present value of a $500 margin is lousy compared to the net present value of a $1,500 margin. But now take the gold price up $1,000. If you take the gold price up $1,000, the increase in margin enjoyed by the efficient producer is something like a third of the increase in margin enjoyed by the inefficient producer. So ironically, in a rip-roaring bull market, the worst companies do the best. There was a point in time in my career, which is to say 1988, 1989, 1990, where I decided to play the game. I thought that the gold price had to go up. I bought the inefficient producers, and in particular, I bought the optionality stories, the Silver Standards, the Pan Americans, and I reaped unbelievable rewards. The problem with that is that the rewards that accrued to people like me in 1990 drew in billions of dollars of imitators. And now marginality, optionality is in the market, I believe, overpriced. There was a time, there was a place, and this isn't it. Perhaps it's a function of my age. Perhaps I believe if you take away most of my downside, you can have some of my upside. I'm sorry with that. I'm okay with that. What you look at with the XAU is you look at 5 or 6 very high quality, very efficient companies that are not poorly priced, but they deserve a premium for their capital allocation skills, for their balance sheets, and for their pipeline. That's just, in fact, the case. If you go down the quality, you see 2 things. One, the increase in passive investing, which means that the juniors need to consolidate and build scale to lower their cost of capital. You see a preference in the market for multiple asset producers rather than single asset producers because of risk. And you see, as we've discussed earlier, what Doug Casey or H.L. Mencken originally would describe as the great unwashed, which is to see a whole bunch of companies that are basically uninvestable in any circumstance. But the truth is that there is not enough interest in the juniors, and there's not enough work being done by the speculators to separate the wheat from the chaff, which is exactly where the opportunity is. If you, as you suggested and Lobo suggested, do the work, there are probably 5% of the junior universe that I think offer up spectacular value. The problem was, the problem is, and the problem always will be that most of the speculators buy the narrative as opposed to reality, which is why the junior market will always be more efficient at counterfeiting than the government. Why sell work when you can sell narrative? Your margin on narrative is 100%.
If
Great
not
thoughts
more.
there. I want to shift to uranium for a moment and read a quote from Harris Kupperman's recent report, because I think both of you would echo the sentiment as well. He said, I find that investors increasingly act like goldfish fixated on the most recent data point, incapable of holding a thought for more than a few seconds. With spot prices having peaked out at over $100 earlier in the year, investors suddenly seem obsessed with the recent soft pullback while ignoring how we got here. Furthermore, this is all amplified by a general misunderstanding of the uranium market itself. I'd like to get your thoughts on that. Are most speculators chasing the spot price and not understanding the term contracting, and the opaqueness of the uranium market. They think that catalysts will instantly reflect in the price. And when that doesn't happen, well, we've all seen what happens on uranium Twitter. Lobo, I'll go to you first again.
I'm gonna I don't want to pick a fight with a fellow Puerto Rican here. You know, Cuppy is always interesting, entertaining, but he also likes to throw mental Molotov cocktails into the conversation to stir things up, somewhat like my friend Doug Casey. By the way, to the previous conversation, he also described central bankers as clinical morons who dress well. That was that's not an ad hominem I would go to, but it's classic, colorful Casey. Anyway, Cuppy's remark, sure, that's true. And anybody who's done any amount of research into the uranium space understands that long-term contract prices are more important. I mean, as far as the actual business of producing the stuff and therefore exploring for the stuff to put into production, that's what matters, not spot. But it's an opaque number that is not available. It's not even available to most people on a daily basis, let alone an instant quote basis, the way we use futures contracts for quoting spot gold. So it's not wrong for people to look at the spot. What else do they have? If I'm trying to make a decision today, and I'm not going to have fresh data until Cameco puts out something about their next long-term contracting or whatever, it's a tough nut to crack. So I think the case is valid, but it can be carried too far. In the dearth of other data, it's not wrong to look at spot. And by the way, the two do correlate. Sometimes spot gets ahead of itself. It did in 2007. It did just this year and late last year, going up to $100, well ahead of long-term contract. So the good news here, I think, is that spot has now corrected back to contract. That is highly supportive, and there's no slowing down in the long-term contract. So if the real price, or the more important price, is still doing this with no sign of rolling over, and the more volatile, less important prices now come down to that level, I think that's very bullish. I'm not worried about spot having corrected at all, and the fact that emotional, disgruntled uranium bugs and former uranium bugs are selling now on what is really a very normal correction after a hockey stick move, I think is a spectacular opportunity for anybody that missed the big run up in 2023. Uranium spot doubled and the stocks moved, at least the better ones did. And by the way, if you're one of those people who complained on Twitter or X that, hey, uranium has doubled and my uranium stock hasn't done anything, well, the market is telling you something about the quality of that stock. I'm sorry, but you need to look in the mirror and have a conversation about who picked that stock. So long story short, I'm extremely bullish. I'm not at all concerned about the spot market volatility. I agree with Cuppy on that. And I just see it as an opportunity right now.
Absolutely agree with you. And it is funny. I had somebody post on my Twitter that uranium hasn't done anything since 2020. And I'm looking at a chart of URNM and just scratching my head. Like, we're not looking at the same chart here. Rick, your thoughts?
This is pretty simple. It's a metaphor for junior speculation. People, many people, not all people, many people buy these markets based on a long-term narrative. They listen to somebody like me talking about the supply deficit, about the utility of nuclear power to society, which is in and of itself 5 or 10 year data. And they employ a short-term strategy. The problem isn't the uranium market. The problem is the psyche of the speculator. If you're buying a 5-year narrative, you have to have a 5-year strategy. These folks, because they do no work, have trauma holding stock over a long weekend. The data becomes an excuse to act on their feelings. I guess I'm fine with that, frankly. Those people are my normal and natural victims. My job is to be a pawnbroker to market sentiment. And without people acting foolishly, I'd probably still be in the restaurant and nightclub business. So I guess I should thank them in my own way. But I think two other things. I agree with Lobo that the spot market is useful, just in the sense that the spot market for gold and the spot market for oil and the spot market for copper are useful. They are a data point. If you use that data point in conjunction with the premium or discount to spot enjoyed by the Sprott Physical Uranium Trust, you get a sense of sentiment. You see that in very few other markets. When the Sprott Physical Uranium Trust, which, by the way, generates substantially more dollar volume than the spot market in uranium does, it really is the tail that wags the dog somehow. When it's trading at a substantial discount, what you know is that in the near term, the market sentiment, the speculative sentiment, is bearish. And you should consider buying. Certainly at discounts below 15, you absolutely should consider buying. At premiums, when you're seeing Sprott issue a lot of new units in the aftermarket to buy uranium, taking advantage of what Justin Hume calls the flywheel, you should consider selling. It means that there's too much positive sentiment in the market, despite the fact that Sprott must buy spot when there is a premium. But people miss the importance of the term market. I spend a reasonable amount of money every quarter to have some young genius, who shall remain nameless so other people don't hire him from me, to look at the financial performance of Cameco and Kazatomprom, to try to determine, because they don't have to report, the dynamics of their own long-term contracting. If you can see, as an example, that they're selling uranium for an average selling price of X, you get some sense when you look at the supply that came from new mine production relative to other sources, what the construction of their term market contracts is. What changes in the uranium business as a consequence of the spot market, the consequence of the term market, is that for the first time in my lifetime in a commodity, there is certainty with regards to price and volume. Companies can sell in a term market to an investment grade counterparty, not to a trader, by the way, but to an investment grade counterparty, a CGN, a Tokyo Electric Power, a Duke Power, a Southern Company. And the securities analyst, some fat old lazy guy like Rick Rule, or a lender, some fat old covetous lazy guy named like Rick Rule, has, for the first time in his career, the only sense of, inexact perhaps, what revenue, margin, and volume will look like 10 years out. That lowers the cost of capital for the industry relative to any other commodity. That's what's changed in the uranium business. If you look at the 90 uranium juniors that at present don't have a viable deposit, the term market is irrelevant to them in the near term until they make a discovery. If you look at the 10 or 12 that appear to have viable deposits, the fact that they can lock in what is in effect offtake with credit grade counterparties means that they actually can raise the financing to build a deposit themselves rather than having to sell out. They can sell out, but there's dynamic tension in the market. The buyer knows that they can't wait out the junior because the junior can forward sell enough material to raise the debt and equity to build a deposit. And that changes a lot of stuff. Now, that's a very complex answer. And speculators don't like these sort of abstract answers. I can't tell you how many times I get an email from somebody who says, Rick, skip all the bullshit. What do you have that's going to triple in the next quarter? And I always send back an email that says, your debit balance. With an attitude like that, the only thing that's certain to go up is the amount of money that you owe your broker if you're buying on margin. So people need to understand that.
Great. Well, I want to shift to some other commodities now. I'm actually going to separate this
Before you do,
question.
let me jump in with one point. Sorry.
Please.
This is, I think, a really important point neither of us made, and that is at plus or minus $80 a pound, uranium doesn't have to go up.
Correct.
The actual business, again, the actual business of getting that stuff out of the ground and delivering it to the customers, we are at or above the incentive price required. So to make money in this space, it actually is not necessary for uranium to continue rallying, or spot at any rate. All we got to do is have long-term hold, which it hasn't. I mean, it's still going up, right? But even if it went sideways from here, that would be just fine. And for the developers that have assets worth developing, that's just fine. You can still make money on it. And for the prospectors that have prospects that, deliver the goods, that's just fine. There is money to be made here without uranium having to do yet another hockey stick or something like that. And this is something that people don't want to hear. People only care if the price isn't going up, everything is bad and miserable. That's irrational. It's wrong-headed. And sooner or later, reality always matters.
Yeah, very well said. I want to divide this question into, Lobo, I want to talk to you about copper and get your view on copper, because I know that's a space you follow very closely. And then I would like to get Rick's view on the energy space, oil and gas and coal. Lobo, let's start with you and give us your current view on how you see the copper market positioned.
Well, I'll be brief here, but I got to give a quick nod to Rick. Early in my career, Doug and David Galland, the partners at Casey Research, I don't know how, maybe just power of friendship, got Rick to sit down with me and a couple other guys and spend an entire day of Rick Rule's time. I don't know what that costs, but if he billed on an hourly basis, you do the math on Rick's alleged net worth. He spent an entire day educating me about the oil patch. So I can't say everything I know about oil comes from Rick, but A, thank you. I'm acknowledging an intellectual debt here, and I appreciate it. But B, I understand why you divided the question this way, and I'm absolutely happy that you had Rick take on the energy one. Though arguably copper is now part of the energy mineral suite these days. That said, my view is very simple. Two things. Steve Martin comes to mind. Two simple words, but no, I got more than that. One, I'm extremely bullish. This is a multi-decade bull. Everything that you've read and seen from reputable sources, and I don't just mean newsletter writers like me, I mean the Wood Mackenzie's of the world and, the big firms out there that have, 1,000 times or 1,000,000 times the research budget I do. They're telling us that the copper deficit going forward, the structural supply constraints in this market are big, basically unfixable. And that's not even counting the green agenda on top of that. So we're looking at a very bullish scenario for copper, decades to come, which brings to mind what Rick just said. If your investment time frame is a long weekend or no longer than that, this is completely irrelevant to you. It doesn't matter how bullish Lobo is on copper for 2030 or 2050. That's way beyond your time frame, and you should keep that in mind. But for what it's worth, that's where that is. This is the kind of thing where if I had the intestinal fortitude, or if I thought all the audience had the intestinal fortitude to buy a great company that is unlikely to face solvency issues no matter what happens in the recessions ahead, and just buy it and stick it in a drawer, forget about it, and let my grandkids benefit from it, copper would actually be my top pick there over uranium or even gold stocks. Gold itself, of course, is savings. So that's how bullish I am on copper. And I put that first because my near-term outlook is actually quite bearish. I've been on team hard landing for a long time. I can't say I've been a lone wolf on that, but it has been a fairly lonely path to listen to mainstream media. And now the mainstream conversation, team no landing's gone away. Team soft landing is now battling team hard landing on mainstream media. The center of mass in the debate is coming towards my position. And that's bearish for copper. And by the way, recall, soft landing doesn't mean, hey, we get off scot-free and nothing bad happens. A landing of any kind, soft or otherwise, means recession. So what they're saying when they say the soft landing is the more likely scenario now is that we're going to have a recession. It's not going to be too bad. Well, guess what? Industrial minerals always get whacked going into a recession. Now, bear in mind, this doesn't necessarily mean that the recession is so bad that the business actually goes under. That can or cannot happen sometimes. But going into that perception, that capitulation of the generalist investors that sometimes dabble in commodities to holy beep, it's really happening. That's always bad for industrial minerals. So near term, I'm not putting any money into copper like Santa Claus. I'm making my list and I'm checking it twice, and I will be growing that and updating that and piling up cash for when I am ready to pile into this generational opportunity. I'm just not willing to buy that or any other industrial mineral, uranium being the exception, ahead of recession, denier, capitulation. That's my actual near-term call. I think that happens before the end of this year. It could happen tomorrow, as you and I and Rick are speaking. It's, Fed Day Eve, a kind of diabolic time to record an interview. But if the Fed scares the market tomorrow, or when you hear this, perhaps last week, with a 50-point cut and hard landing stock, this is not a prediction. I'm saying if we get a scare and the hard landing alternative becomes dominant, I would expect lower copper prices and other prices and greater opportunities, therefore. So hear me clearly. I'm not saying copper is bad. I'm not a copper bear. I'm saying, I'm not trying to time the market, but I'm saying that the odds favor a great buying opportunity ahead, and I'm building cash for that.
And Rick, your thoughts on the energy space? In that conversation I also had with Gehring and Rosenzweig, they singled out natural gas as an area of the market they think there's a tremendous amount of opportunity in, and not many people are paying attention there. Obviously, they're also tremendously bullish on oil as well. I'd love to get your thoughts on both those commodities and how you see the coal sector playing out as well.
Well, with the caveat that I grew up in the oil and gas business, so I'm more comfortable there than any other business. In fact, I'm more competent in oil and gas than I am in mining. But the truth is that in mining, you can be less competent and still make money. The challenge in mining is often to get under the bar in terms of knowledge, as opposed to over the bar being so low. That isn't true in the oil and gas business. I'm agnostic as to how I make my money in commodities. I'm fine with sand and gravel. I prefer what I would describe as tier one deposits, irrespective of commodity, which is to say, in my view, deposits with in excess of $10 billion in recoverable reserves and resources, in the best cost quartile in the sector, and in the best return on capital employed in the sector, but at least capital employed over 25%. And the oil and gas business has many more of those than the mining business. It's a target-rich environment. It is exposed to the same vagaries in commodity demand as copper, so it is economically sensitive, like Lobo described. And I used to ascribe some value to my sense of where the economy was headed. Again, in reference to Doug Casey, he and I joke that we have absolutely corrected forecast 17 of the last 3 recessions. And so what I have done is maintained positions in very, very, very high quality natural resource plays, including oil and gas plays, and speculated in deposits that I think might increase. But I also have an awful lot of unallocated capital. And I have an awful lot of capital relative to my net worth exposed as a lender, which is a much more conservative strategy. With regards specifically to oil and gas, with that disclaimer out of the way, it is a better business than mining. So it attracts more of my capital. It's a bigger business than mining. It has a lot more data than mining. And I think it suffers from even more negative sentiment than mining. The big thinkers of the world, Justin Trudeau, Kamala Harris, that noted energy physicist, Greta Thunberg, would have you believe that peak oil demand occurs in 2032. I don't know where they all get that consensus number. I think peak oil demand occurs in 2065 or 70. If you do a net present value calculation and your tail goes out to 2070 rather than to 2032, you get a much higher current number. And the market seems to substantiate what I say. What about alternative energy, says Greta. And Justin, for that matter. Your audience needs to understand that as a society, we've spent $5 trillion on alternative energies. And I'm not against them, by the way. I've spent some of it. We've reduced the market share of fossil fuels from a high of 82% in 1982 all the way down to 81% in 2024. This is not competition I'm afraid of. A $5 trillion investment has raised the market share of fossil fuel, lowered the market share of fossil fuels by 1%. Meanwhile, at current oil prices, which I believe are low, the best quartile in the Oil and Gas Journal 400 are generating over 50% profit margins. Compare that with the mining business. On top of that, and this is bullish for the commodity, not the stocks, the International Energy Agency estimates that the oil industry worldwide as a collective, a good phrase for it, by the way, if you include parastatals, is underinvesting in sustaining capital investments by $1 billion a day. If you underinvest in sustaining capital, you deter your ability to produce in the out years, reducing supply. There are good companies which are at the same time maintaining their sustaining capital investments and also increasing returns to shareholders. This is an extraordinarily virtuous circumstance. And I would agree with your former guests that for people with a longer term perspective, North American natural gas is perhaps the most attractive commodity of all. The AECO, the Alberta Gate price, right now is something like $1.50 US per million BTU. Henry Hub is something like $2.20 per million BTU. Occasionally, the price of natural gas in Midland goes sub-zero because it's a byproduct of oil production. That same gas landed in Rotterdam or Shanghai or Tokyo or Seoul goes for $8 a million BTU. And for reference, it costs $1.50 US to get it there. So if you do 220 plus $1.50, what does that get you? 370 for product that you get to sell for $8. And there's billions of dollars of this trade. The consequence of that arbitrage is that billions of dollars is being invested to shrink that arbitrage. And it will shrink. This is an absolute no-brainer. Could it be delayed by recession? Absolutely, positively.
Just quickly, your thoughts on coal as well.
The joy's out of the coal trade. The joy was in the coal trade in 2020. It was an absolute no-brainer. The coal equities were selling at 1.5 times free cash flow. They're all the way up now to an appalling 5 times free cash flow. So the easy money has been made. The big money may be ahead. It's odd, Jesse, that a narrative that's absolutely certain but hasn't yet been demonstrated by price attracts no adherent. And after the narrative has been justified by price, when most of the value has been arbitraged out of the narrative, attracts all kinds of attention. Now that coal stocks are trading at 4.5 or 5 times free cash flow, still a discount to the rest of the mining business, there's a whole bunch of people that want to be in the coal trade. After the better coal stocks are up 500%. We observed the same thing in uranium. When the uranium price had to go up, nobody cared. When it did go up and didn't have to go up anymore, everybody cared. While this is sad for the market, it's good for VRIC.
Fantastic breakdown from both of you. This has been an awesome conversation. Before we do end things, Lobo, tell us about the independent speculator, what it is you do there, where people can
Before I go there, I got to say, if Rick and Doug have predicted 3 of the last 17 recessions,
other way around, 17 of the last 3.
Bear in mind that the Fed has predicted 0 recessions ever. So I'd rather listen to Rick and Doug, at least have a reason to be cautious, as opposed to Pollyanna sailing into the storm. So just for whatever that's worth out there. Another thing, sorry, I know you need to wrap. We've been going for almost an hour here, but what 2 answers you just got with oil and copper, which in many ways are similar, I think highlight an important difference between Rick and myself. And this is not a negative. People often ask me, why does Rick say this and you say this? Why do you differ on this, that, and the other? Well, besides the fact that we're friends, we're not afraid to contradict each other. He has a different business than I do. I'm an evil scum of the earth newsletter writer. He's a laser guided pawn shark, right? These are different businesses. And if Rick has a 5-10 year time frame and he is willing to stick through thick and thin, I've seen him do this. I've seen him replace the entire management team on something that didn't work out because he refused to lose money, right? I can't do that. He can. And if I, as a newsletter writer, say, hey, buy oil, it looks great for decades to come, and then we get a recession and oil stocks tank, that will hurt my business. I will hear no end of pain from my audience. So I don't claim to know any more about the next recession than Rick or Doug. I just warn about the possibility, and I'm unwilling to invest ahead of that in case, the worst does come to pass. So I just wanted to clarify to the audience, when you hear these different answers, we're disagreeing and we're not. We have different business perspectives. We're coming at it from a different point of view, and you need to pick and choose accordingly. Sorry, I went too long on that, but this has come up repeatedly when people ask me about this sort of thing. And I'm not throwing Rick under the bus here. He's still smiling, I think. All right, so to answer the question, and this gets back to something else you asked earlier. One is, this is the free weekly letter. If you sign up for the Speculators Digest, the one thing I promise, you may not like it or whatever, but I promise we won't spam you with a flood of daily advertisements. I hate that. So, but the other thing I would say is our My Take service. It's somewhat similar to Rick's rating service, except I charge for it, but I give you a lot more detail. I give you the story, I give you the pros and cons, and I follow up on it. There's a database now of almost 1,000 company evaluations. So when you ask this question, how do you do due diligence? Well, you can put the work in, or you could hire me via my service to do it or help you with it. But the main point is, you can't just trust these IR guys or gals, no matter how much they smile at you. They're not your friends, they're salesmen. And you have to understand that you are on the other side of the table on a game of poker, and their interest is not that you win. It's on your responsibility to work for that. And yeah, it's work. If you want to make money, guess what? You have to work for it one way or the other. If you just want to be a gambler, go to Vegas.
Well, I will put a link in the description below to the Independent Speculator. I definitely highly recommend your free newsletter. It's fantastic. I also know one of your analysts, Vukashin, lives near me in Serbia. We meet pretty regularly, and he's a very, very sharp young man. So
He's a beast.
if that says anything about your business, I think it reflects very positively. Rick, talk to us about Rule Investment Media, your portfolio grading service, any
And
events
Battle
you have
Bank.
coming up, and of course, Battle Bank. You've got the shirt on. We got to discuss it.
4 points. I only subscribe to two mining investment services. I absolutely recommend what Lobo does for free, but I recommend more highly what he does for pay. I've watched him now earn his stripes over 2 decades, and I have to say I'm impressed. I liked his idea. Well, maybe it wasn't his idea, but his suggestion that however incorrect Doug and I may have been with regards to forecasting recessions, that we did better than the Fed. And I would suggest that Americans listening to this program nominate Doug Casey for Fed chair. I think Fed meetings would be a hell of a lot
I thought you liked Doug.
Well, you notice that I wouldn't nominate me for chair. In terms of my services, there's 2 things I'd like to talk about. Of course, from my point of view, the greatest investment conference in the world, if you're willing to pay for one, is the Rule Natural Resources Investment Symposium. You actually get there through the Rule Investment Media. And so to attract your attention and to further education, go to my service, ruleinvestmentmedia.com, list your natural resource stocks, and I will rank them for free. No obligation, nothing else. Once you're there, occasionally you'll be propagandized to buy investor education, either by way of boot camps. By the way, we have a wonderful upcoming boot camp on investing and speculating in tier 1 deposits. These boot camps are 8-hour long, in-depth, deep sessions about how to improve your investment performance in one particular technique. We've done uranium, we've done silver, we've done prospect generation, all that kind of stuff. So you'll get propagandized to buy that. It's a $99 charge if you attend the boot camp. If you aren't happy for any reason, we'll give you the $99 back. The other thing, of course, is any of you out there who are Canadians or American who are unhappy with your current bank, I suspect that means all of you, should check out Battle Bank, a bank with a difference. A bank that pays you interest on your deposits, including your checking deposits. A bank where if you establish an IRA, it's your IRA, not Fidelity's IRA. You can buy rental residential real estate, which you operate in the IRA. You can buy crypto if that's what you want to do. You can buy precious metals. You can buy a franchise. Your IRA can legally be your IRA. It's just that the big financial supermarkets would prefer that your IRA was their IRA. And at Battle Bank, by the way, if you own gold and silver and you want to borrow against your gold and silver, I know Lobo doesn't like this idea, but if you want to access the capital that you have tied up in gold and silver, either to diversify or to buy more gold and silver, Battle Bank, unlike any other bank in the United States or Canada, considers your gold and silver to be good collateral. If the idea that your IRA should be your IRA, or if the idea that you should be paid interest on your savings, and if you want, denominate your savings in 18 currencies rather than just the US dollar, or if you like the idea that you might, if you wanted to, access the capital that you have stored in gold and silver, check out Battle Bank at battlebank.com.
Great. I'll put links to both Rule Investment Media and Battle Bank in the description below. Thank you once again, gentlemen, for coming back on the show. It's been a blast.
Thank you.
We will all see each other, I suspect, at the Vancouver Resources Investment Conference
Yes.
in January, if my memory serves me well.
Absolutely. Looking very much forward to that.
Great.
Likewise.